Well, good day, traders. Chris Weston here, Head of Research at Pepperstone. Some really interesting dynamics playing through financial markets. I want to explore some of those because they've absolutely shown their head this week. They've become crystal clear to investors, and we want to explore whether these have some longevity in financial markets and what is the trade that needs to accompany this going forward. Of course, if you're bearish on global growth and risk assets in general, it's been quite a tough week. Has this got further to go, given that there's probably an element of euphoria baked into the cake at the moment? And that's kind of what we want to explore. So we're looking really at event risk. We're having a look at implied volatility to get us a sense of the expected moves up or down from current spot prices of other asset classes as well, such as the S&P and where the VIX is trading, bond volatility, to get a sense of whether people see the event risk over the week as something punchy and potentially a volatility event. That's really important, not just for opportunity and the strategies that you're going to employ, but also for your position sizing and obviously how much risk you're taking on the portfolio. But let's go straight to the boards. Let's get a sense of what's happened throughout the last 5 days. And you can see here, really, you've seen some big moves. These are currencies traded against the US dollar. You can see right at the top there, South African rand doing really, really well, up 2.5%, 2.6%. Obviously the scenes that we've been seeing in Cape Town, Durban, Joburg and alike, the celebrations after winning the World Cup won't have done the perception of retail sales any harm whatsoever. But of course, this was the idea that Moody's didn't cut them down to junk, and the currencies benefited from that situation as well. But we have seen emerging market currencies doing a little bit better. The extra liquidity that's going through the world, this idea that we're seeing reflation, and that's a theme that we want to explore in a little bit throughout this video, is definitely testament to what we've been seeing there. The market obviously very beaten up. The South African rands struggled of late, so I think probably a bit of a position adjustment there as well. We've also seen buying coming through in the Norwegian crown, the fact that oil prices, the WTI prices are $57 and Brent's a little bit higher, obviously testament to that. The peso's done quite well. Korean won, obviously the Korean won very much, it's a currency that I talk about quite a lot in this video, and it's something that I look at very closely as a proxy of what's happening in China. And a proxy of risk appetite more broadly, and that's done quite well against the greenback as well. And if that's continuing to find buyers, then we'd expect other risk assets to do quite nicely as well. The Singapore dollar doing quite nicely. On the bottom of the pile, you've seen the Brazilian real down 2%. That's a function that they failed to get any kind of foreign bidders for some of their domestic oil wells. The idea that there's going to be less capital inflows to take advantage of that, I think, sort of causing a few anxieties. And then the Japanese yen in G10, the worst performer. So obviously that's a reflection that we've seen a positive backdrop. The S&P continues to make new all-time highs. We've seen a bit of a sell-off coming through in the bond market, and if you actually look at this chart of copper, I think it's really interesting. If you want to talk about what's happening at the moment, it is this perception of reflation, the idea that we've seen somewhat better data of late. We can see the payrolls number, the services ISM number. You can see German factory numbers, again, showing signs of stabilisation. And there's other metrics we can look at as well, certainly the Taishan numbers coming out of China showing multi-year highs there as well. So things aren't as bad as what people were predicting. This idea that we're getting a recession has come out of the market. Have a look at those moves that we've seen in the bond market. Go to the 3-month 10-year Treasury curve. 29th of August, that was trading negative 55 basis points, deep inversion in that part of the curve. That's now trading at 35 basis points. So that's a staggering sell-off, steepening of the curve that we've been seeing there. 2s, 10s sitting up nicely. You've seen real yield, both 5 and 10-year real yield, moving up quite sharply. And I think that's a really interesting thematic. If real yield's moving higher, it's part of the reason, it's probably the most important reason why gold prices are struggling at the moment. But if we do see the rate of change moving higher in real yield, that's inflation-adjusted yields, then I think that the S&P may find a few headwinds. I think funding costs do matter at the moment. But that's really what we've been seeing. So that chart of copper, I think, is a really interesting one. It's not just what we've been seeing in the yield curve, but it's also, if you can go into iron ore, that hasn't really moved, but it's copper that's got that PhD in economics, so to speak, and that's moved a little bit higher in line with what we've been seeing in the curve. And the idea that we're seeing reflation, emerging market currencies working well, going into the ETF structure. Have a look at the EEM, looks pretty nice at the moment, breaking out, and the the Asian DXY, the Asian dollar index, looks really nice as well. I mean, that's kind of where we've been seeing. So those dollar index, those Asian currencies working really well against the dollar, and that's the kind of theme that we're in. We're seeing this reflation, this better liquidity environment, and Asian currencies seem to be finding a bit of a mojo at the moment. Now let's have a look at the event risk for the week ahead. Let's go straight to what's happening in the US. The big one for me is what's happened later in the week. We've got core CPI and headline CPI. The market's looking for that core number 2.4, headline 1.7%. We know that core PCE, the one that the Fed obviously look at, the inflation that the Fed look at very closely, is still well below target. But if you look at wage data in the US, if you look at the Fab 4, which you can see a chart of here, you can see that they're all trending a little bit higher. This is something that Jerome Powell looks at very closely at the moment. It gives you some belief that things are getting a little bit more inflationary in the US. But so that CPI number there, I think, is going to be the highlight of the week, as will retail sales as we go through the back end of the week as well. Also, have a look at what's happening when the Fed speakers. There's a whole raft of Fed speakers due this week. You can see that on this table that I've put here. And I think it's really important whether actually we get firm clarity around what's happening in policy and Fed policy and what they might do in the December meeting. But we do get Jerome Powell speaking, we've got Richard Clarida speaking, and we've got John Williams speaking, the big three on the Fed board. So that could be something well worth watching as we go through the week there as well. Of course, it's headlines around trade. The world's getting very excited about what's happening, a potential trade deal. Now, that phase one trade deal, are we going to see tariffs rolled back? My best guess is that we will see some signs of tariffs being rolled back, but Donald Trump and his trade negotiation team will want to keep an element up their sleeves so that if China are set some targets that they adhere to them, they're going to use that as a surveillance situation. Those tariffs will not be completely rolled back. China is saying they want them fully rolled back. I suspect what we're going to see is that being brokered, that we will see an element of tariffs being rolled back, but the US will certainly want to keep something there. And how much will China buy in terms of ag products and various poultry products as well as that offset as well? So that's something we are watching. Donald Trump will be speaking in the new week, and we get that coming out on the 12th. He'll be talking about trade in the economy. So Donald Trump coming out and speaking to the public could be an event risk. What we've been seeing mostly has been around things around tweets and also headlines from Reuters and various factors. But I think that's going to be a must-watch situation for traders. That trade and economic policy is the title there, something to definitely watch. In the UK, if we stay on the political theme, obviously it's really looking at the polls. Will Boris Johnson garner that majority? At the moment, it's looking somewhat unlikely. The betting markets have got him to the Tories to win, but probably not by the majority. They need the 320 seats there. But there is a data dump to watch, and that could influence sterling. And sterling's trading in that sort of 130, 128 range at the moment. If it breaks out, obviously that needs to be respected. But we've got GDP numbers coming out. We've got inflation numbers towards the back end of the week. The market's looking for 1.7 on headline, 1.8 on core, and then the RPI numbers and retail sales later there. So it's not all about Brexit. I know we generally think it is, but I think will we see the sterling being influenced by some of this data here as well, and that's something to be watching. In Australia, I think as we go through the week, we're going to be looking at NAB business confidence, Westpac consumer confidence, but we also get wage data, and also I think the big one there is going to be the jobs data. Obviously, the RBA looking very closely at the labour market, so we'll be looking very closely at those jobs data which come out later in the week on Thursday. The market's looking for the unemployment rate to stay fairly similar, but we're looking at the number of jobs created. The market there is looking for net 18,000 jobs to be created going forward. So I think that's going to be something to watch. China, we're going to be watching for what's happening in their credit data. We're not sure exactly what day that comes out. They don't give a definitive data on the credit data, but we're looking at new yuan loans, we're looking at aggregate financing, and we have seen that credit impulse moving up, and that's part of the sort of better liquidity environment we've been seeing in global markets. As we go through the week, though, on Thursday, have a look at the industrial production numbers. They were at 5.8% last month. They're expected to tick down to 5.4%. We'll have a look at retail sales and fixed asset investment as well. But China's been part of this better trade recently. Certainly those Taishan manufacturing numbers were a little bit better, and certainly service numbers were okay. But will this data now, the high frequency data dump, justify where we are at the moment? Something to definitely consider going forward. There's some factors which we're seeing in Europe. We're watching that ZEW confidence numbers, GDP and CPI numbers, but everyone's getting a little bit excited that the German finance minister and certain factions there are talking now about being open to fiscal stimulus and fiscal unity at a banking level. I think that's something that we will be exploring and is definitely a euro positive longer term. Now let's have a look at how markets are interpreting this situation. Let's have a look at the vol chart here. Go into that sort of middle column. You can see 1 week at the money implied volatility. I've got that dollar turkey. It's still 14%, but that's the 12th percentile, so it's still pretty low. But volatility is very, very low. Apart from the Kiwi situation there, you can see New Zealand implied volatility, 1 week implied volatility is 8.4. Now, I missed out that because the event risk for traders, if you're trading New Zealand dollar, you do have a really big central bank decision coming through from the RBNZ during the week. Now, the market is pricing about a 60% chance that they're going to cut. The economists are split, so it's a live meeting. For me, I wouldn't probably want to run positions over that, but you could see some volatility. Now, what's the market expecting in terms of a move up or down? It's about 63 points. So you've got Kiwi dollar against the US dollar expected to trade that range from spot 64.32 down to 63.06. That's got a 68.2% level of probability, or confidence, should I say. But outside that, volatility across G10 is absolutely shot to pieces. If that is a consideration for your position size. You can afford to run tighter stops. You can have bigger position sizes, and you can see here from the implied move what that implied volatility results if you're looking at straddle pricing and the theoretical price of those options. That is the implied move up or down throughout the week with a 68.2% level of confidence. Now, I could take that level of confidence out and look for strangles and look for a bigger outlier move. I haven't done so. But you can see, for example, on sterling Aussie, you've got a 185-point move. You've got sterling dollar yen, 55 points. Now, I would use that specifically to understand how much risk I want to take on. People would use the ATR, which you can see on the left-hand column, but I would actually use that as my sort of guide there in terms of volatility. At the bottom there, you've got the VIX and how that's trading. Again, we've got very, very low volatility in financial markets at the moment. It's a function that all central banks are still very accommodative. They stand prepared to do more if they need to, but at the moment they've got this prolonged pause, and that is because they want to see how things are progressing. The economic data started to turn a little bit better. We've got better liquidity environment coming through in markets, and financial conditions are very, very accommodative at the moment. So certainly central banks very much on hold. And I think, if I go to the chart of interest rate probabilities, you can actually see on the third column just exactly what's priced in. Go to the RBNZ, 60.4% chance. We've got 23 basis points being priced over 12 months. So, just one rate cut being priced in pretty much over the coming 12 months. In Australia, the December meeting got a 13% chance of a rate cut. 13 basis points being priced in. So the market is saying, on balance, that we've probably got a 50-50 chance of actually seeing one more rate cut. My base case is we get one more rate cut, and that comes in the February meeting. But you can see now that what's been happening is this better environment that we've been seeing. There's very much a wait-and-see situation. So that's reduced a lot of the volatility. So we go into the new week with a fair amount of event risk to contend with, but markets are saying that the central bank meetings and the upcoming meetings are more a wait-and-see scenario playing through. So really that's what we're looking at. If I go through to the risk reversal chart, which you can see here, this looks at the skew of volatility, 25 delta put versus call volatility. And you can see here, for example, in cable, where that's 0.11, that tells me that call volatility is slightly higher than put volatility. That tells me that the market is seeing a slightly higher bias for upside in cable. If you've got a negative number, the market's been higher buyers or been paying up for put volatility. That tells you there's downside structure. Now you can see that the market's expecting slight downside in the Aussie and downside bias in dollar yen. But what we then look at is where that is in relation to the 12 months and that IV ranking, or that skew ranking. And we can actually see that whilst they're negative, they're right up at the top end of the range. So traders have been, buyers of risk and expecting those currencies to perhaps do quite well. I think the Aussie is a really interesting one because, whilst we're looking at the data, it still remains very much a play on emerging markets. That 200-day moving average play on your daily chart, I think that's 69.46 or 49 or so. If that breaks there, I think that's been guiding the currency for some time. So that's something we're watching. But the currency, again, which we're watching throughout the week and remains one of my must-watch currencies, is dollar CNH. That looks like it wants to head down to 6.8, and that remains your beacon for what's happening in trade. If we get that feel that perhaps all tariffs are going to get rolled back, I don't think they will, but perhaps they will, then you're going to see that CNH strengthen and dollar CNH go down, and that's going to continue to have this risk-on vibe in markets.